we detected an unusual trade worth $31 million on Super Microcomputer stock, ticker symbol SMCI. But here's what makes this even more interesting. Super Microcomputer is scheduled to report earnings in a few days on August 5th. And so, in this video, we'll break down this unusual options activity to figure out whether this wealthy investor is going bullish and buying, expecting the stock to move higher, or bearish and selling, expecting it to drop lower. Because, as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, including potential access to earnings data before it's public, giving them an edge to make better, smarter financial decisions. This is how smart money always stays one step ahead, well before the rest of the market catches on. No wonder the rich get richer. And so, to level the playing field, let's dive into the unusual options activity to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. Now, as we can see here, on the chart, the stock is trading near its high for the year, right at a key level of resistance based on technical analysis. Earlier this year, this level rejected the price, sending it lower. So the question now is, will it get rejected down again or break through? To get a better idea, let's take a look at what smart money is doing. As we can see here on the options time and sales tape, the most unusual trades happened on July 29th at around 11:45 a.m. at the 53-second mark, for these August 15th options at the 45 strike calls and the September 19 options at the 60 strike calls. A quantity of 50,000 contracts were being traded at these option prices. Now, based on our deep analysis of the data, this wealthy investor was closing out of these 45 strike calls that expire August 15th and then rolled into new trades with a later expiration date and a higher strike price. This means that these September 19th options at the 60 strike calls are the new open trades. And so we can calculate the total cost of this new trade by multiplying the number of contracts by the option price of 6.25 per contract. Since option prices are shown here, and each options contract controls 100 shares of stock, to get the dollar value, we multiply by 100, or simply move the decimal 2 places to the right. That means each contract costs $625. So by multiplying this cost per contract by the total quantity, 50,000 contracts, the total trade cost comes out to approximately $31 million for this unusual trade. But keep in mind, the earnings report is being released soon, so this is a higher risk trade in comparison to the trades that we share on our website. And so, if you want to get access to the lower risk trades with a higher probability of profit, then go to our website. We'll put a link up here. Keep in mind that our members also get earlier access to trades like this before anyone else, even before we share it with the public. So if you're tired of being late and want more time to act on these opportunities, just head over to our website, where you can see in real time when and which stocks wealthy investors are trading on Wall Street, so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, you might be wondering, how did we know this wealthy investor was closing and opening these options contracts? Because if a wealthy investor is closing out contracts, it could mean they're worried about that stock. So maybe it's not the right time for us to jump in. On the flip side, if a wealthy investor is opening new contracts, it could signal an opportunity for us to start a new trade. And so, let's dive deeper into the data on the option chain and take a look at the August 15th options, where we can see something interesting. At the 45 strike calls, there is only 44,806 open contracts at the open interest, which is less than the 50,000 contracts that were traded. So why didn't the number of open contracts increase for this option? Well, because this wealthy investor was not opening new contracts at this specific option. Instead, they were closing their existing positions here and rolling it to a higher strike price and a later expiration date, to the September 19th options at the 60 strike calls, where there are 62,674 contracts opened, which is greater than the 50,000 contracts traded. That tells us this wealthy investor opened new positions here since their 50,000 contracts were added to the existing open interest. And that is why we also opened a new trade, but we used a different options strategy that cost much less, about half as much. This allows us to position size more effectively and manage risk more efficiently. As we can see here on the options time and sales tape, we focused on these August 8th options at the 60 strike calls and the 70 strike calls. Notice that 5,998 contracts were traded. And so our trade strategy is shown here on the option chain for the August 8th options at the 60 strike calls. Our position is here, marked as POS, with the green color indicating a buy position. And at the 70 strike calls, our position here is shown in red color, which indicates a sell position. Now, take a look at the open interest here. 9,981 open contracts at the 70 strike calls and 10,289 open contracts at the 60 strike calls, showing strong activity and interest at these specific options. And so we bought these 60 strike calls and we sold the 70 strike calls, setting up a vertical call spread that cost $243 in debit per contract. Now, let's analyze our trade using the risk profile graph, where the profit or loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so, when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, as the share price goes down, this trade becomes more negative, more loss. And as the share price goes up, this trade becomes more positive, more profitable. That's because our trade is going long, bullish on Supermicro computer stock with this option strategy. We can also confirm that by checking the options Greeks. This trade has a positive delta, which means it's positioned long and bullish. If it was a short bearish trade, we would see a negative delta instead. But keep in mind the risk with this trade, it has a negative theta, which means it loses value over time due to time decay. And that is why you can see here, the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break-even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $60, the stock needs to trade above $62 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, including earnings, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here, where you can also learn more strategies to increase your profits. Let us know in the comments, do you think Supermicro computer stock will move higher or drop lower? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.